Good afternoon, everybody, and thank you for joining today. I will just wait for a few moments to give a few more people a chance to join, and then we'll begin. Brilliant. I think we'll make a start. So again, good afternoon, and thank you, everyone, for joining today. Today, I'll be giving a webinar on the cash flow and liquidity template application that we've built at Bedford Consulting for yourselves. And I'll be taking you through what the model does and how, of course, you can use it. My name is Samuel, and if you have any questions at all, please do feel free to put those in the questions pane that you should be able to see in the control settings, and I'll do my best to answer them before the end of the webinar. But alternatively, of course, there will be contact details provided, so you can get in touch and we'll be able to respond to those as soon as possible. So I'll begin with a quick introduction to Bedford Consulting, but before doing that, let me explain what we're doing today and while we're doing it. I think as we all try to navigate through this crazy time, we at Bedford wanted to help in the best way that we know how, and that, of course, is through the Anaplan platform. So what we're effectively offering here is a free Anaplan cash flow template app to Anaplan customers, and it's for you to use within your workspace to help you through this tricky time in terms of managing your short-term cash flow and liquidity. So the model will be looking at a 13-week cash flow, but we'll go into that in a little bit more detail in just a moment. A quick overview on Bedford for those of you who don't know us already. Bedford Consulting are the oldest and largest solely focused Anaplan partner in EMEA, and we're the EMEA Partner of the Year for 2020, and it's our 5th year in a row actually. And we have over 150 Anaplan customers with over 300 implementations, which of course contributes to being the largest Anaplan partner. With that, we have over 40 Anaplan experts, and all of us, of course, use the one proven methodology, which is the Anaplan way. And I'll be touching today, in addition to the application, I'll be touching on some of the services that we offer, some of the additional services in the Bedford Academy, and of course through our Service Plus, which is a managed service as well. A quick run through on Anaplan momentum. So commercially launched in 2011, there are already over 1,400 customers in over 40 countries. So a true global organization, headquartered out of San Francisco, but of course began here in York, and there is still an office in York, as well as, of course, as the office in King's Cross in London. So Anaplan, for those who don't know, is a native cloud-based connected planning platform and very much the leader in that space. So what is this application? As briefly mentioned just now, it's a short-term cash flow model. So it's a 13-week cash forecasting tool that we've built for you. And it's designed as a template. It's a starter app rather than a production-ready model. So there's no warranty, as we're giving it away for free, but it does serve as a fantastic starting point for building a cash flow model and cash flow logic in Anaplan. So that's really the hope here, is that you'll be able to bring it into your workspace, get to grips with it very quickly, and use it as a starting point for a cash flow model internally. It's available free of charge to Anaplan customers only. So unfortunately, sorry partners, it's not free of charge to you guys, but of course everybody is welcome today in the webinar to see the app. But Anaplan customers, it's absolutely free to use. So this is something that we made available to you, and I have some slides later on that touch on the contact details so that you know how to get the app and how you can reach us with any queries as well. And although the model only looks at 13 weeks with a focus on short-term cash, of course, in the present situation that we're in, short-term cash with current volatility is a key focus, I think, for all organizations. But the model can be adapted to longer time ranges, monthly, yearly, and so on. And of course, it can have additional modules as well. So we can add modules in relation to, for example, corporation tax, dividends, debt financing, and so on. As with every Anaplan model, it's scalable, it's flexible, and you can make the changes and customizations that you would need and want to make. But here, of course, you have a nice base to start from in this app. So the app has three core functions, if you like. The first being ledger modeling. So you can quickly update sales and purchase ledgers into your short-term cash flow. And we'll touch on all of these points, of course, as we go through the demonstration later on in the webinar. You can overlay payment terms to progress or delay invoice payments. And again, these will all be driven by your standard dimensionality in Anaplan. So we're looking at the management of lists and assumptions against those lists. We'll show you how we brought those together in the model so that it's nice and easy for you to use, but of course still very powerful in how it flows in real time through to the cash flow. And you can review aged creditors or debtors across multiple versions, with multi-dimensionality, of course, being at the core of the modeling that we do in Anaplan. When we start to look at forecasting, we can forecast sales and purchases by customer and supplier. So again, we can manage those lists in the back end, and we have a few bits on maintenance that are nice and easy that show you how you can maintain this model moving forward and set some of the general parameters. And you can model various payment terms to see the impact on cash. So you'll see that we have some charts that will show you the impact on cash and your cash balances, your cash goals and available cash. And we have that flowing all the way through the model. For any changes that we make, the key focus is always, of course, that we want to see that impact on cash. So we're always bringing it back to that in the model. We can forecast employee costs and utilize furlough schemes where required. So through this COVID-19 time that we're going through, of course, the furlough scheme is something that is becoming more and more common in discussion, but also in reality for organizations. And we can quickly model forecast scenarios through versions and other dimensionality through lists in Anaplan. And then on the cash flow, we can review the cash flow by currency to identify currency specific weaknesses. So I'll show you how we will be able to flick between pages in terms of currency and how we can look at our local and reporting currencies and how we can set any assumptions or properties against those. And we can model VAT deferral based on HMRC guidelines and quickly compare that to base scenarios. So again, in terms of this kind of schemes that we're looking at the moment through this period, of course, we have the furlough scheme in relation to employee costs, but we also have a VAT deferral scheme that is available to us as well. And finally, we can quickly roll forward to new 13-week timescales or create multiple like-for-like scenarios. So coming back to that multiple versions and multiple scenarios in our scenario modeling, we're able to do that, of course, through this model and through the application that we're going to show today. So I'm now going to jump over into Anaplan. Bear with me 2 seconds. I'm just going to change the screen over so you'll be able to see the other side. Brilliant. So here we are in the app, and you can see here that we are looking at our 13-week cash flow. And we're on our home page where we can have a nice overview of pretty much everything. We can see the key bits that we want to see here in relation to, first and foremost, if we're okay, and we are, and I'll explain why we're okay in just a moment. But here we can see our closing cash balance, our available balance, and of course our cash goal. And we can see all of those in our chart, from the closing balance that we can see here with the bars, and then of course the line that's showing us our available balance, the gap, of course, being our overdraft facility in this case, and our cash goal as well. And we'll drill into this in more detail in a moment as to how we get to these numbers and what makes them up, and how we can flex and adjust some of the inputs so that we can forecast through this. But one of the first things I want to touch on here is what we can see. So we're looking at Anaplan's new UX, new user experience. So for those of you that have seen Anaplan before or are used to using Anaplan, this may be new to you. You may be more used to the classic user experience through dashboards. Not to worry, it is the same Anaplan that we know and love. This is built on a model that is based on modules, lists, and so on. So there's nothing new there. The difference is that now we're able to utilize this new UX, the new user experience, which basically sits on top of the models and pulls the information into pages so that we can now move through these pages and see it through a more intuitive and a better user interface and a better user experience. Very quickly to show you the background, it's driven by this model. So this cash flow and liquidity model in the Anaplan that we all know and love in the back end. And we can see here that it's broken up into a few key functional areas through our payroll, payables, receivables, forecasting, with a few reports as well that are pulling through and some admin bits as well. But in the back end, it's exactly that which you know and love. You'll be able to go in and make all of the kinds of changes and customizations that you would do in any Anaplan model. There's nothing black box here. There's nothing that's locked. It's just that we've simply taken some of the legwork out of it for you by building the template so that you can have a good starting point for the cash flow model. So let's navigate through the app and see what we're looking at here. So as we said, we've got our closing cash balance and we've got our available balance. And the difference between those is, of course, our overdraft. And then we've got our cash goal, which, as we can see, is our 3 times payroll. So what we're effectively saying here is that in relation to that cash goal, we basically want to have 3 months of cash at any point in time to consider ourselves safe. Up here, we'll be able to see our opening cash balance at 35,000, and we can see our closing cash balance at 97,985. And we'll drill through these to see how we're getting these numbers in just a moment, as we start to flow through looking at our cash inflows through our overdue invoices and invoice values, our outflows through our payments and payment values, and of course the schemes that we were speaking about a moment ago when we look at our VAT amount deferred, and of course our furlough scheme as well. The okay that we're looking at here is because in this view that we're looking at, in the scenario that we currently have, we basically have the cash available to do that which we need to do. Up here, we can see that we have a drop down that's showing us current. So this is referring to the version that we're looking at. If we were to look at scenario 1, for example, we would see that it's giving us a big flag and it's telling us that something's wrong. And the reason is because you can see that we haven't actually forecasted any kind of overdraft facility here. So in this situation, we're seeing that our available balance is actually in line with the closing cash balance, and that drops below 0 from week 14. So that's why it's flagging that there's an issue here. But we'll go through this in just a moment to show how we would fix that in relation to that scenario for comparison later on. In terms of this model and how it works, so we'll move through these pages and I'll show you how it sort of flows through the pages and the interaction that we can have with the model. But at the beginning, I think it's a good place for us to start in maintenance so we can look at how we may want to set this up. And in this maintenance page here, in this model setup page that we're looking at, we can now start to set some of the parameters and assumptions that are going to drive the rest of the model. So from our model parameters, we can see that we're now looking at our standard supplier terms and our standard customer terms. So these are the receivable and payable days that will be the standard terms that will apply to all of the customers or all of the suppliers within any list. We then have our model reporting currency. As we were speaking about FX earlier, the model will refer to local and reporting currency. And we, of course, have chosen for our reporting currency to be GBP. And we can see here that we've given a list of pound, dollar, and euro. Now, for those that are familiar with Anaplan, of course, you know that these are just lists in the background. We could have those lists say whatever we wanted them to say. For those that are new to Anaplan, everything we're seeing here is customizable. Where you see the writing being purple or the font being purple, that's because we can edit it, we can input against it. Where you see it being black, that's because it's formula driven, which means that it's driven by something in the background. So for example, here where we're seeing the standard supplier terms of 30 days, if we're then to click through and set that to 60 days, you'll see that down here in terms of supplier properties, each of the suppliers have got forecast terms of 60 days. We would then have the option to change the specific forecast terms for any one supplier, and we can do so in here. So that we can say, actually, this specific supplier we work, for example, has 30 days instead of rather would have 60 days, the 30 days instead of the 60 days that we had set previously. So that's how we would interact with that at this early stage. But I'll show you how that flows through because we tie that into the rest of the model. Similarly, in terms of the customer terms, we have the same kind of setting here. So for the choices that we make in terms of the days, for the terms, that of course will flow through to the customer. So the 30 days that we're seeing are flowing through to each of the customers, and then within each of those customers, we can of course make any adjustments that we wanted to make to that individual customer. We can see further information in relation to VAT percentages, which again are centrally set. So when we look at the country assumptions, we can see that for UK, Ireland, and Germany, we can see the currencies, the VAT percentages, the sales and purchases percentages that are coming from those. And we have a flow here that we can pull through so that we can link through to our sales aged debtor report and of course our purchases aged creditor report. But we can also reach those through another route, which I'll show you in a moment so that we have a bit of detail on what we're looking at. For the information that we have in the system, of course, we're going to want to import it. So we have a nice easy integration here so that we can set templates and import those files. And from here, we'll be able to import and export anything that we wanted to from the system. So it's all set up as a nice template as a starting point, whether it be that we wanted to have ad hoc update of hierarchies, and we could of course do so here in relation to product, customer, cost type, and supplier, and so on, or whether it be that we wanted to import transactional data, whether it be purchases, invoice, and so on. So jumping back into our cash flow and looking at the model and what it does and how it works. If we go into the actual cash flow here and look at the breakdown that we have, we can see the same chart that's giving us the overview in terms of our closing cash balance, our available balance, and our cash goal. But we can see as we look down here at the cash flow statement, we can see the week commencing date. So we're looking from week 12 through to week 24. So we can see the dates that relate to those. And then we have a breakdown here initially looking at receipts. So we can see the sales ledger runoff with the receipts forecast and receipts adjustments. The adjustments as an overlay we can input from here. But the receipts forecast we'll come to in just a moment when we start to forecast our sales, and the ledger runoff when we start to forecast our receivables and adjust our receivables. I'll show you how we interact with that. Operating payments, we can see here from salaries through the tax that we would pay on those salaries, the pension that we'd pay on those salaries, any redundancy that we may have to pay based on needing, of course, to make people redundant, and any furlough refund as well, because we will be looking at modelling in relation to that furlough scheme. Again, we have an option here to input any final adjustments that we can, of course, input in this final stage here, giving us our total employee payments. For the purchase ledger runoff, working in a similar way too, but of course with the opposite effect of the sales ledger runoff, we can look through here from the purchases ledger runoff, where we'll look at our forecast of payables, and then of course the VAT payments and refunds, which will tie into the VAT fund, the VAT scheme, which we'll go to in just a moment, and then of course the final adjustments just as we have for the others, all of which will flow into those net operating cash flows. And then of course our non-operating payments, which at the moment are just an input. So at the beginning in the slide when I was saying that we could have amendments or adjustments, so we could add modules that might refer to corporation tax, dividends, capex, and so on. This is where you may want to have those modules feeding into. At the moment, it's just based on an input or an import for this template. All of this would give us our net cash flow. And of course, we can then see our opening balance, the movement, and the closing balance. And we can see here, of course, that 35,000 on the opening balance that we were referring to just a moment ago when we were looking at this page. So coming back to this summary and looking at how we get to those numbers, we have our opening cash balance at 35,000. And where that's coming from is the input of our actuals. So we would import our actual closing balances, and we're doing so here from week 1 through to week 11. So we are then forecasting from week 12 through to week 24. The forecast input is effectively the overdraft facility that we were speaking about earlier. And we can see that that's purple, so that's being imported or input. And of course, the import of the actuals that we're bringing in is being pulled in either via an import through the page that we looked at earlier, where we can click the button, or of course, it could be an input manually. More importantly here is where we're inputting the data. So here on the top, we can see the banks that we're putting it in, the bank accounts that we have. And we're always inputting in local currency. The reporting currency that we have is in pounds, as we saw on the parameters. So we have a roll up here of all accounts, and that of course is referring to our reporting currency. But we can see here that the input for HSBC in this case, of course, is in pounds. The input for BOI is in pounds. But if we were to input for our euros, the reporting will use the exchange rate that we have, so that we'll be seeing it in pounds. Okay, so we'll be able to pull that through as need be. Down here specifically, if we take the forecast that we have here for overdraft, we can see one of the first ways that we can interact with the model in terms of affecting whether it's okay or not. So here we're okay, we have our forecast of overdraft, which makes sense. If we look at our scenario 1, we can see that, of course, we haven't forecasted any overdraft. Coming through to our opening cash balances, it will, of course, be pulling from the same actuals. But when we're looking at our forecast, we'd want to input by scenario. So we can see here that we have our current input, which we have at 27,000. But it may well be that there is an option for us to have more or less. Let's take 40,000, like so. And we'll put that in as our forecast overdraft in relation to scenario 1. So now what that means, as you would expect, is that when we come back to our cash flow, because we've now pulled through that forecast, we would then be able to see that flow through for the relevant piece. So while we have now a higher line, so we can see that our available balance is slightly higher, still not quite enough for us to pull that through. And just to keep things positive here, as we have enough doom and gloom, I think, as is, let's increase this to a level that's going to actually give us a positive sign there. So we'll start on the right foot. Like so. So for our scenario 1, we can now see that all is good, provided, of course, we can get that overdraft. And then, of course, we can see that in our current, it is as is because it's unaffected. The key thing here, regardless of the numbers that we're putting in, is that we have that scenario analysis. So we're always able to work through those dimensions. We're always in a position to say, what would it look like in this situation? What would it look like in that situation? And I think that's really key, especially through times like this. So once we've input our opening balances, we know that we've got our 35,000 as an opening balance, because that, of course, was the closing balance of the last period of actual. So that's where the 35 is coming from. And then we've got our closing balance, because that's, of course, the end of the movement that we have. And that's what's pulling through in the cash flow that we can see beneath. So now let's start to work through some of the pieces that we have here. So if we look on the cash inflows initially, let's look at our aged debtors. So looking here at the aged debtors, what we can see is that we have a breakdown by customer. So initially looking by all customers, we're able to see that we have the 30 days that we expect, because we saw that through the general parameters. And as we saw through those general parameters, we also have the option to adjust those terms so that for any specific customer, we can change this to be a different payment term if we want to. We can then see the current receivables. So the current receivables are the receivables that we're expecting within the current payment term. We can then see that which is overdue with a breakdown of 1 to 30 days overdue, 31 to 60, 61 to 90, and 90 plus, of course, with a total at the end. So if we go into this in a bit more detail, what we're able to see from here is within each of the customers that we have. So for example, looking here at customer 2, we can see that customer 2 within a specific product, because the hierarchy that we've chosen is to go from invoice into product into customer, we can see all of the invoices that relate to this customer in this product. So we're starting to drill down in granularity from initially looking at the cash flow that was giving us that highest level, to then be looking by customer, to then look within the customer at the specific invoices within those receivables. And in that, we can see the gross invoice amount, the invoice date, we can input any description that we would want, and of course we can see those final terms. The adjustment to those terms, of course, we can make as well. The key thing here is the way that we interact with it. So for the 6,000 that we have in relation to this specific invoice, if we look at this 0032, we can see that we have a 30-day term as standard, but we have 6,000 that falls outside of that term. So if we were feeling particularly lenient for that specific customer, we would be able to make a change here in the adjusted terms, which would then mean that now it's falling within the current because it's no longer out of date, it's no longer overdue. As a result, that 6,000 is moved from here into the current, and that of course is changing those receivables in relation to current, and that of course is being reflected throughout the rest of the model in terms of flowing all the way through to when we would expect to receive that money. These real-time updates are of course really key because it's enabling us to make changes at the very lowest level that are rolling up into the very highest level in terms of reporting. And that's something that you'll be very familiar with in Anaplan, of course, because that's what it does. But the key thing is the way that it's enabling you to do that here within this model. So if we start to look at the on those inflows, if we look at them in a little bit more detail, and we look at those aged debtors. Bear with me. So here we're looking at each of those invoices that we were just looking at a moment ago in that breakdown. So we're looking at the total and the cash flow, then we looked at our customers, then we looked through product and we're looking at the invoices. Now the view that we have here and what we're able to do with it is that we're currently saying within the specific customer that we were looking at, customer one, we're looking at product A and we're looking at the two invoices that are overdue or written off. That's based on the filter that we have up here. So what we're effectively saying is these are the invoices right now that are either overdue or written off. And the key thing, of course, is that this is going to be based on the changes that we just made. So whether it's overdue is going to be based on that setting that we previously made when we moved that 6,000, because that's going to determine whether they would fall into this category or not. Another key point here is the invoice status. So in this invoice status, we can see that this has been partially paid. When we're looking at customer one, these two invoices have been partially paid. Now it's been ranked in terms of the days that are overdue. So we can see that invoice 0001 is particularly overdue, 0016 slightly less. We can see the credit terms payment date and the invoice status here being partially paid. We can see the invoice date, the actual payment date, and then of course we can see the amount that we've received. So the amount being received being 500, the gross invoice balance being 1,000. In this case, of course, the invoice balance being 24,000 and the amount that we received being 2,000. We can see here that we would need to manage this in terms of receipt. So the key issue here, if you like, is that the red flag that we have here is because if we don't input a date, then ultimately we're saying that which we've received is all that we will receive. So we would need to put a date in for when we expect to receive the rest. And that's the reason why it's flagging it, to make sure that we're not missing any receivables that are owed to us. And we can see that on this specific one here on 001, where only 2,000 of the 24,000 has been paid, the outstanding balance in local currency of 22,000 is, they've called us up and they've told us it's going to be due on the 1st of April, for example, for the purpose of this. We can see that that's week 14, and therefore we'd be expecting that in the week 14. So that would be tied into that week 14. Now, if for some reason we believe that to not be happening, we have the option in here to write that off. And in doing so, we can see that real-time impact happening up here, that this would become 37,881. If, however, of course, that's not written off with the date that we're expecting it, that 37 becomes 57, because of course it's accounting for that amount. So the changes that we're making down here at this invoice level are flowing all the way through to this chart here at the highest level. And of course, that which we're looking at in this chart is the same as that which we're looking at from this perspective, and therefore the same that we're looking at when we drill into it from here to look at it in our cash flow. So when we're looking at that sales ledger runoff, we're seeing that in here in relation to the specific periods that we're looking at. So I think it was week 14 that it was looking at, and we're seeing this 43,664. But of course, as we go through to here and we look to write that off, we can then come back into that same view of the cash flow. And when we look at that for the sales ledger runoff for that week 14, we see that that now drops down to 24. So for all of the changes that we're making, they're updating in real time, and that's rolling all the way up through. Okay. In terms of views, so we've chosen here to see the overdue and the write-offs. If we untick that filter and refresh the page, we can now see everything in relation to customer one. But within that, you'll see that we can see the pieces that are not, the invoices that are not overdue, so they're still within their term. And of course, we can see the ones that are. Similarly, we can look all the way through on all of the customers so that we would now be able to see everything that applies, all of the invoices that would apply to all customers. And in that, we can see anything that we would need that's being flagged in terms of asking us to do something. Here you'll see a show invoice due in next. So this is the weeks that you would want to see. And the options that we have here, for example, we may say that we only want to look at the next 3 weeks, for example. And in doing so, we can then hit refresh up here, and it will now just narrow that scope. So what it's now doing is only showing those which are due within that period, so that we always have the option to determine whether we're looking at an extremely short space of time, or if we, of course, if we wanted to be looking at a longer period of time as well. In relation to the cash flow that we're looking at here, of course, we're looking by versions as we saw a moment ago, and we always have that dimensionality running through the model, which is key. But we also have another dimensionality that we can look at here in currency. So in looking at the cash flow by currency, we can now start to look through those currencies that we have. So here we have data in for pound and euro, and we can now look at the closing balance by currencies. We'll be looking from week 12 through week 24, which of course is our time frame, but we're seeing that difference in currency. Up here, we can see the balances by currency as numbers. So we can see our opening balance in pounds, we can see the closing balance, and of course, we can see any movement as well. That's being reflected down here in our cash flow by currency. Right now, we're looking at pound, and of course, we could also look by euro or any other items that we wanted to look at. Whatever currency we wanted to look at, of course, we would simply need to include it in the list and then update the relevant currencies. If we come back out to our cash flow now and continue through the flow, we've now had a look at our cash inflows. So now we'll take a look at our cash outflows, and we can begin here with our aged creditors. So working in a very similar way to that which we just saw in relation to the aged debtors, here instead of by supplier, we can actually look by cost type. So within each cost type, we're initially seeing our terms, and those terms are based on the assumptions that we saw in the general parameters as per the initial page that we looked at. We then have an adjustment similar to what we were looking at before, in that we could now say actually for those which we wanted to change, by making it 60 days, it will then move some of the ones from before into the current. And that, of course, will then change that showing on the filter when we start to look at the way that we want to manage some of those items later on in the later stages. To drill into that in more detail, here we have that same grid, so we can see our aged creditors by cost type. But then, of course, we can look now at each of the invoices in exactly the same way. The invoices that we're looking at are specific to the supplier. So we're now able to come through and start to pick. So we may say we want to look specifically at WeWork, so we'd be seeing the WeWork piece, or of course, we could be looking at all categories, in which case it would, of course, show us all of them. And the way it's working through here is that we can see our supplier, we can see the invoice with the roll up, we can see the invoice date and the description, we can see our final terms, and of course the adjusted terms, as we were looking at just now in terms of moving those across by making changes to those adjusted terms. And of course, we can put in any commentary, which of course is key for us to be able to explain why it is that we're making certain changes in certain places. A key point to note on the purchases, and if you like, the inverse of that in relation to receivables, is early payment. So to come back to this one in just a moment, if we go back to our debtor report, when we're looking in here and we're looking at changing some of those terms as we did, one of the key points to note is that we may well want to be, in this time especially, trying to encourage early payment. So one of the kind of add-ons that you may be looking to do would be to have a discount offering so that you could have an earlier payment. So if we just come into this section here so that I can show you that and where that may fit in to the bigger picture. So in here where we've got the adjusted payment date, and we'll look at the inverse of this in relation to purchases in a moment. In here is where you'd be wanting to make that change, and the add-ons that you may be looking at in terms of customization may be in relation to discounts that you would offer, so that of the amount that's being required, you may look to offer that discount as a flex with a percentage. Obviously, what we're covering in here is that you could put it in as a partial payment and effectively write off the rest, but you could choose to drive that if you wanted, of course, with a percentage. And the reason I touch on that is because when we look at that on the other side in relation to overdue payments, we would have the inverse, where the goal here, of course, is to be extending those payments. So it may well be that we're either receiving discount offers from those which that we owe, and we'll be making those changes here in the adjustment dates, and of course in the amounts that we're going to be paying. Or of course it could be that we're actually writing off certain amounts as a result of discount offered, or because we're simply not able to pay certain pieces. All of which of course can be managed from here in a similar way, but of course the inverse to the receivables piece. So we have a description in here. This is our weekly social media campaign, and we're looking at this in relation to, for example, Google Ads. And then in here we can see the number of days overdue. So of course the starting with the worst, if you like, and then getting to the best or getting to the better. We can see the supplier category codes, the cost types, and the status, the invoice date, the local currency, which of course is key. The reporting currency is always going to be in pounds because we've set that centrally. We can then see the import amount with the sales tax and our total amount in local currency with any outstanding balance. In here, we can see the payments that we've made, and this is where we'd be making those adjustments, which will be flowing through in terms of the amount that we want to pay, and if anything is to be written off as a result. Now, the impact that we see of that are obviously going to be based on the term. So where we're only looking at 13 weeks, it may well be that the changes that we're making in here would fall outside of that 13-week period. And as a result, not all changes that you make here will be seen within your window. So of course, be aware of that. But as you extend that window when you roll forward, of course, then you would see those changes taking effect as you start to fall into the relevant periods. Going back into our cash flow here, and now looking at our VAT amount deferred. So now we're starting to look at one of the two schemes that we have available at this time in terms of VAT deferral. And what this is showing us here is a breakdown of the output VAT from the sales ledger, which is based on the actuals that we've imported, and then the output VAT based on our forecasted sales estimation. Now, the forecast, which I'm going to touch on in just a moment, is based on weeks, as we have seen. But of course, here we're looking at calendar months. So it's using 445 months to map into those calendar months. So just a point to note in terms of the way the two are working there. That's going to be giving us our total output VAT, okay, from the two. And then, of course, we have the same on the input side. The actuals coming from the purchases ledger, the forecast coming from that forecast piece, which will be by week, which I'll touch on in just a moment. And that, of course, giving us our total input VAT. As always, we have the option for an adjustment that we can input at a high level. And then with that, we would have our total VAT that we can see running through this row. Beneath, we have our VAT payment month. So here we're able to choose the months in which we'll be paying the VAT. And if we look up here in the top corner, we can see the VAT payment day of the month. So we're saying that the 9th of April, July, and October are going to be when we'll be making those VAT payments. And we can see the relevant payment week being highlighted based on the day and the month that has been selected. From that, we can see the calculated cash flow impact, and that, of course, is going to be the number that's going to be flowing through into that cash flow so that we can see the impact when it starts to contribute to the available balance that we have and the closing balances that we have. Down here, we have a manual adjustment of cash flow. So we can make manual adjustments to the cash flow impact, which again, as you can see here, is purple. So that will be a manual input. And then, of course, we have that option to defer. So the option to defer is an option that we choose here based on that selection. And that option is going to be determining whether that comes out of our cash flow. So you'll see that because it's ticked, the cash flow impact used of 2193, by ticking it, we're saying that that's not to be used effectively. As we come through here into the pages that we have, we can now choose where that takes effect. So we would then have the option through our setup to determine where that would actually take effect in terms of the months or the weeks when we'd be looking to do that. Our VAT payment page, as we were looking at just now, is where we'd make those ticks, and we can of course see that summary as we want to through here with a central setting of when that takes effect. So the choices that we make are of course central in terms of that global settings, but in here we're going to of course need to input the period when that would come back. So if we were to take it out of here, we would then want to input through this line when that cash flow would actually be paid, when it would be deferred to effectively. So as a quick overview, quick snapshot on there, we have our output VAT that we would have from our ledger and from our forecast. Forecast I'll touch on in just a moment. Forecast is 445 being mapped into calendar months. We then have the input piece again through actuals from the purchase ledger, forecast coming from the piece which I'll show in just a moment. We then choose the payment month. We choose the day of the month. And of course, we can then see that impact, but we can choose to defer that impact and then of course say when that impact would be likely to take effect. And of course, by inputting when that impact would take effect, that would then flow through to say when that is going to be used. So the piece that we would have had in here, we can then say is actually going to take effect in here, is ultimately the way that that's working. On the forecasting piece, let's quickly look at the sales forecasting worksheet. Looking at time here, I see that we've got 15 minutes left, so I think we're okay for time. Here's the forecast in terms of the sales forecasting, and this is a worksheet. So in the new UX, we have pages that will either be boards or worksheets, and ultimately they have slightly different ways that you can interact with them. What we've been looking at all along have been boards, but we're now looking at a worksheet. And in this, we're able to look by customer, so we can see those products by customers, as we were saying, and we're looking by week. So we're looking from our week 12 through to our week 24. On the right-hand side here, we can see some additional insights. So we can pull through that chart that's giving us a real-time update of what's happening in relation to our closing cash balance, our available balance, and our cash goal for 3 months or 3 times payroll. And in here, we can look at our customer one, and we can now look to forecast customer one in relation to that product A. So you'll see that the 1,000 that we have here is in relation to local currency. And then we have the reporting currency of that, which is going to be in pounds. And we can see that is 885. And then, of course, we have the gross invoice payment, which will be including VAT. So when we're inputting at local currency and we want to be making any changes, the key thing to note here is that for the changes that we're making, for example, in week 17, the impact of that is going to be in line with the terms that we have, the receivable terms that we've put in place. So if they're 30 days, it's going to apply accordingly. If they're 60 days, it's going to apply accordingly. So if we expand this out to its full view, it's just important to note that this item that we're seeing here is not going to be reflected in the month that you've seen. It's going to be reflected at a later point. So we're seeing that here in week 21. We're seeing the 2655, even though the change has been made in week 17. And that's based on those payment terms. So adjustment of those payment terms are going to bring that nearer or move it further based on the days from that point. So just a key point to note there. But the weekly forecast that we're inputting through this stage is the forecast that's going to be driving those numbers when we're looking at that cash flow. So as we come back into our cash flow piece in here through our reporting, and we start to look at some of these items down here that we were looking at just now. So for our VAT payment and refund, based on the selections that we've made, if we had chosen to defer, of course, this is where we'd be seeing when that payment will happen or when the payment has been deferred to. In terms of the salaries, we will come to in just a moment. And in terms of the sales ledger runoff and the purchases ledger runoff, we've seen those in relation to those forecasts. Okay, let's look at our furlough scheme. So one of the key schemes that we have at the moment that are being made available to us through this period. Up at the top, we can see our total staff costs, and we can see that for the total, and we're looking, of course, at a 13-week period. We can then see the total furlough receivable, so effectively the amount that we would be receiving for that furlough scheme or for opting into that furlough scheme. And then we can see the staff cost saving that we would be making. And a choice here as to whether or not we will be implementing that scheme or not. So of course, if we're not implementing it, then of course there'd be no receivable, there'd be no saving. So here we can see our employee list, and the employee list that we have is across all departments or whichever structure it is that we would want. We can look at that in its entirety as always, or of course we can pick out a specific employee as we have done here. We can choose the nature of that term, whether it be of that contract, whether it be a contract or a permanent, and of course we can look at the start date of them, the leaving date, and so on and so forth. We can see the currency that's relevant, and that's likely to be based on where the employee is, of course, based. Then we can see our annual base salary, which is an input, the pension rate, which of course will be an input, and any other benefits as well. Now, the key thing here is in relation to furloughing that specific employee, we would set a furlough start month and a furlough end month, and then we would simply make that applicable by ticking it. Now, if we look down here at these months that we're looking at, so we're looking at April to May. So we're looking at April and May. And if we tick this to apply it, what we see here is that the 5075 in terms of the total month staff costs, including furlough, reduce because the total furlough receivable is applied down here. So we can see the cost excluding furlough. We can then see the way that that's being split out. So the total cost saving in this case is saying that it's going to be full because, of course, there's effectively nothing being paid there. There is, of course, the option to top that up. So in topping up that salary, what we'd then be able to do is say, well, actually, above that threshold that is provided, we would now be able to top that up and see the impact in here through the top up amount. So bear with me while this refreshes. And then we can just quickly choose a different one. Okay, good. So for employee A, we choose to top that up like so. And by clicking top up, we can see the top up amount that's being pulled through to bring that in. And that, of course, is then reducing that staff saving accordingly. So where that was at 5,000 before, that's now at 2.8. So for the selections that we've made now at this lower level, The key thing is the way that this will, of course, look in our cash flow. When we come through to that granular detail here, we can now start to see how this looks from this level. Now, again, it's going to be based on whether it falls within your window or not. So for the periods that we're looking at with the furloughing from April to May, we're seeing that that won't be applied within this window because of when it would fall. But of course, for that which would have been applied previously, you would then, of course, see that flowing through in this section here. And in terms of when that would then be paid back to you, if you had paid out at that point, you can then make those assumptions through the payroll assumptions. Looks like I've got a bar stuck on here, just bear with me. That's better. You can then see the payroll assumptions where you have every single assumption that you would require in relation to payroll. So from here, you'd be able to say the furlough received from HMRC date. So we can see where that would kick in. So we can see then, because we've furloughed for when we have, it would fall outside of our 12 or 13 week period. But of course, for anything beforehand, we'd be saying that we're going to receive that furlough from HMRC on this date. So that, of course, would flow into the cash flow. And we can relate that to the payday that we have here. In terms of all of the thresholds that we have all of our national insurance thresholds, which we can see all through here. And that's everything from supplemental NI through to employers NI threshold. We've got the basic PAYE thresholds here, the different bands, and of course the different rates. The furlough scheme. So here we can see that we're setting that parameter at 2,500 as stated by the government at the moment. But of course, if that needs to be changed, it's extremely flexible in the way that we can do that. We can do that centrally. And of course, there's a furlough percentage, grant percentage here that we can flex as well. And then any statutory redundancy assumptions as well. So we can make any adjustments here in relation to redundancy if we wanted to forecast severance pay or anything like that. We can do so from this point as well. The staff cost payment assumptions at the bottom are looking at the pension payment date and of course the HMRC payment date as well. So coming to the end here as we start to wrap that up, the key thing is in the way that we bring this all together. So of course with cash flow, it affects and is affected by every part of the business. And ultimately, we want a single place where we can see everything very quickly as a snapshot. And that's what this is effectively giving you. And hopefully this run through in this webinar is highlighting the way that each of the different constituent parts through your cash inflows, your cash outflows, and the different schemes that we have through the furlough scheme and a VAT deferral scheme, how they will impact in your cash flow, and how you may want to look at those different schemes in relation to the different versions to have an understanding for which is the best way to navigate, which is the best direction ultimately to navigate through these difficult times. I'm just going to flick back over now to the PowerPoint to finish up so that you can see the contact details